Now that we've addressed the importance of how currency movements can affect your P&L, we'll now present you with some of the outcomes you may experience when performing transactions using non-base currency units. We'll also show you how you can experience different results when managing your exchange rate risk versus borrowing on margin. For illustrative purposes, let's say you're a US investor who's buying shares in a British company that's trading on the London Stock Exchange, or LSE. Let's assume that you have $15,000 in your US dollar account and you're looking to purchase shares in ABC Corp, which are trading in London at £1 apiece. At the outset, the prevailing rate of exchange gives the British pound the power to buy $1.50, placing the sterling equivalent value of your account at £10,000. Given this, let's take a look at what can happen to your P&L under different scenarios when your US dollars are converted to British pounds. Let's say, for example, you've sold your $15,000 and bought pounds when £1 was worth $1.50. This gives you £10,000 in your account with which you decide to buy 10,000 shares of ABC Corp at £1 apiece. Over the next few months, while the share price of ABC Corp hasn't moved, the pound is weakened and now buys only $1.40 upon conversion. Now, when you liquidate your shares at £1 apiece and go to exchange your £10,000, you only receive $14,000, meaning you've just suffered a $1,000 loss. Now, let's say that instead of weakening, the pound strengthens versus the US dollar. £1 now buys $1.60. When converting that £10,000 after liquidation under this exchange rate, you'll receive $16,000 or a $1,000 gain. What happens when the share price moves? Well, if ABC Corp shares rise by, say, 10%, you'll experience a capital gain of £1,000. But depending on the exchange rate of the pound versus the US dollar, you're going to have different outcomes. If the pound buys $1.40, $1.50, or $1.60, for example, you'll have gains of $400, $1,500, and $2,600 worth of gains in your account, respectively. Conversely, if shares in ABC Corp fall by 10%, you'll suffer a £1,000 capital loss, and upon converting your currency after liquidation back to US dollars, you'll see your account fall by $2,400, $1,500, or $600, should the exchange rate of the pound versus the US dollar yield $1.40, $1.50, or $1.60, respectively. As you can see from these examples, with the currency conversion, you'll face currency risk on your principal sum, as well as the potential for daily P&L impacts. However, you won't experience any finance charges as you could when making these same transactions on margin. So let's take a look at what happens when a margin loan is used to fund this overseas share purchase. In practical terms, at the point of the share transaction, your cash account in the settlement currency, in this case British pounds, is zero. Your margin account software may automatically create a margin loan, recognizing that your sterling account is in deficit to the value of the shares purchased. When you buy 10,000 shares of ABC Corp at £1 per share, you'll see a £10,000 margin loan secured against the US dollar collateral in your account. Remember, no matter what happens, you'll need to repay that loan after the shares are sold. If the share price falls, there'll be a shortfall. And if the share price rises, there'll be a surplus in your British pound account. Let's say the share price rises by 10%. This change results in an amount sufficient not only to repay the loan, but also yields a post-sale gain of £1,000. However, the dollar value of this gain will depend on the performance of the pound versus the dollar. A weaker dollar will translate to higher gains, and vice versa. Recall that there's an inverse relationship between a foreign currency and the US dollar, where a strong dollar signals weakness in the foreign currency unit, and a weak dollar indicates foreign currency strength. If your shares in ABC Corp fall by 10%, the repayment on your loan will fall short by £1,000. To pay the loan balance, you'll need to sell US dollars to fund the overseas deficit. The amount of US dollars needed depends on the exchange rate. As the pound strengthens, the dollar value needed to repay the loan rises. In this case, you'll benefit by a stronger dollar, since the shortfall is reduced. When making foreign currency stock transactions on margin, you can see that the currency risk you experienced on your principal sum when trading in your cash account is removed. However, your daily P&L remains subject to this risk. Also, capital losses you suffer on your equity may create a debt of greater value than the original size of your margin loan. You may also experience finance charges, depending on the yield spread between your base and overseas currency. And while your base deposit accrues interest, your margin loan will incur interest. These are the mechanics of an overseas stock transaction. And from these scenarios, you should now be able to assess the risks between margin loan and currency conversion. Overall, you should also weigh the benefits and drawbacks of managing currency risk or taking out a margin loan. And now that we've provided you with a broad understanding of the foreign currency market, its participants, the complex nature of certain trading products, and some of the risks investors typically face, we'll now walk you through how to enter an overseas trade using the IBKR Trader Workstation. Come back and join us.